We're good?
Yep.
This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is here. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode digs into how the CIO of a growing multi-billion-dollar wealth management firm thinks about customization and differentiation with private markets. We sat down with John McArthur, CIO and senior partner at $3.6 billion AUM Krilogy. Founded in 2009, Krilogy provides comprehensive financial planning and investment management services to high net worth individuals, families, and business owners. With John at the helm as CIO, they've been thoughtful with their approach to private markets and have increasingly focused on ways they can create customized and differentiated solutions for their clients. John took 11 years of experience in wealth management and financial planning at A.G. Edwards & Sons and Morgan Stanley Smith Barney to Krilogy, where he joined his former University of Missouri college football teammate Ken Skornia to help quarterback Krilogy and their clients to financial success. John is thoughtful in his approach to private markets and how to provide solutions to their clients. We had a fascinating discussion about how wealth management is evolving and how private markets are critical to growing a wealth management practice. We discussed how John and team have grown and scaled an independent wealth management firm, how John approaches private markets and how that approach has evolved as they work with clients of greater size, how to balance customization and differentiation with scale, how can asset managers effectively educate and provide solutions to the wealth channel, what's still missing from private market solutions for the wealth channel, his views on product innovation, such as Evergreen funds, and advice John would give to wealth advisors looking to invest in private markets. Thanks, John, for coming on the show to share your wisdom and expertise on wealth management and private markets.
In a collision of culture and finance.
We're going mainstream.
John, welcome to the Alt Goes Mainstream podcast.
Great to be here. I appreciate the invite.
Pleasure to have you. I think we have a fascinating conversation on tap. Your background in the wealth management world, your focus on private markets, how you think private markets evolves for the wealth channel. First, where I want to start, though, is you getting into the wealth management space. How did you end up in wealth management?
Yeah, 25 years ago, interesting time at the turn of the century with markets. I think really it was a passion for markets at that young point in my life. And I think that combined with the desire to serve people, I love the stress and responsibility involved in it. And so really that was the impetus, 25 years ago. And then similarly, when I became CIO in 2012, that passion for markets theme kind of bled through.
You say you love the stress of having to deliver for people. What brought that out?
Probably sports related, if I had to guess. Our founder and my business partner, Ken Skornia, and I were backup quarterbacks at the University of Missouri together before we each ended up transferring. Oddly enough, I transferred to Northwestern. And I think that dependability aspect of the position in sport was something at an early age that I fell in love with, and like to make things happen, like to have impact, and kind of the pressure and responsibility that goes along with it.
Well, as a backup quarterback, you're also one play away from having to play.
Right.
So I imagine that has probably made you have a prepared mind for everything that you do in work.
Always be prepared. Yeah, the key, I feel like, to success in a lot of things is preparation. It's funny, that made me think of a friend of mine at AQR had once told me there's no better hire than a failed athlete. I think he looked at himself in that way, and I think of myself similarly. And I guess there's maybe a chip on the shoulder and something to prove aspect that goes along with that.
Well, I think that also is a great transition into the arc of evolution in the wealth channel and in your career as well. You started AG Edwards, then Morgan Stanley. So you started in the wirehouse channel, and then you now are in the independent channel. What do you think you learned from your time and experiences working at big wealth management complexes?
The foundational education that I received at both of those institutions was incredibly valuable. I was in the top performing office in the country at AG Edwards. So just to be around successful people, to get access to, whether it's a due diligence process, whether it's being with a end client and investment banking meeting, those are some really valuable experience.
Tell us a little bit about Krilogy and the journey you've been on since you joined in 2011.
I came at the beginning of 2012. My business partner, Kent Skornia, founded the firm in 2009. And for me, it was really a sensible risk, and it was a belief in the person. It was somebody I had known since age 18. We really took parallel paths in the business, and there was just an extreme amount of trust in him and his vision for the firm. And a lot of that we touched on was centered around being a place where young folks could thrive in our early days. That's kind of evolved over time, but we put a lot into training and teaching and mentoring and developing young talent in the business. So that's how it started. I think as an independent business owner with the rest of our partners, we have both the challenge and the opportunity to influence the trajectory. And I think that's the most fun. We're a team of about 85 today, and we're continuing to learn and grow.
Well, it seems like right now there is a lot of really interesting and exciting things happening in the wealth management space. You're part of that. I think private markets is a part of that too. I want to first touch on, how do you think about growing an independent wealth management firm? You've grown to over a few $1 billion at this point. There's a growth path from here. The space has grown too, and there's private equity in the space. How do you think about the evolution of wealth management, and how do you think about the growth of your firm in that context?
Yeah, it's terrific. We're just shy of $4 billion currently, and one of the key threads I think now on a go forward, and then has been really extreme focus on quality controls around the various initiatives. So for example, we have a tax practice. There's a law firm that one of our partners who's an attorney owns, family office space we're making a push in. So being very thoughtful and deliberate around what growth looks like in different lines of businesses, if you will. The space of M&A and private equity capital has sped up pretty significantly. And so I think it's given us a little bit of pause to just reassess. But, frankly, as we think about acquisitions going forward, the entertaining of strategic capital at some point is probably prudent. One of the key threads, though, around quality controls with lines of business is also the people side of it. If you ask our employees, what makes us special, and it's the people. And we don't want to lose that.
That's a really important and interesting point when it comes to thinking about building and evolving a wealth management business. Is there's so much pressure in the space to grow, and there's an opportunity to grow as well. What do you think the biggest challenges or questions are that you face when you're like, hey, should we think about growing our business or should we just continue to grow organically?
The bias has always been to grow organically. We've made acquisitions certainly over time on smaller scale, but it's got to be a people fit. It really does. I mean, the marketplace is ripe with tremendous opportunities, but it's really got to be a good culture fit for us. I mean, if you think about the time that we all spend going into the office and work every day in collaboration with teammates, it's such a significant portion of our lives. And we want to be able to collaborate and have fun with people that we enjoy being around. So that filter will always exist. Does that prevent us from growing at a faster rate? Yeah, absolutely. But that's just not something I don't see us ever giving up.
It's a really important point though, right? Because at the end of the day, wealth management business is a client service business. You have to deliver for clients. Sure, you can grow enterprise value as well, and that's equally important as a business owner. You should do that. But the business is successful when client service is done well. So how do you think about that balance in the wealth space of growing, but also then making sure that it has to be growth, not at all costs?
Right. That's the lens that we always look at it through, is what increases client satisfaction. I mean, ultimately, nowadays compared to when I started in the business with the do not call list and solicitation was so much more a way to grow your business, 25 plus years ago. Now it's word of mouth, it's referral business. And so looking at everything we do through the lens of what's the impact or the value created for the end family or individual that we're working with is critical. And we feel like making a bet on that and the quality around that experience will more than make up for, pace of acquisition and some of those other things.
You mentioned making sure you provide a really high quality experience. What are the things you can do as a firm when you think about differentiating what you do and your offering to clients?
Some of the things we've done historically, I touched on with respect to tax and estate planning. I mean, that's becoming more table stakes, I think, in a lot of ways. One of our most recent efforts is a private fund that we've just recently put together, which we're really excited about. We've got a partnership with Allocate. Samir Kaji has built an incredible business there with an incredible team. So we're really excited to do a lot of the work that we've done in-house in private markets and partner with them from a sub-advisory capacity to just bring greater value in the space. I mean, when I became CIO in 2012, a big focus was to really institutionalize our process, both in our public markets, discretionary portfolios that we run, but also alongside that is private markets participation. And so that's evolved over time as well.
How important is it to have private markets capabilities when it comes to being able to build a business that has differentiation to clients?
I think it's critical, particularly where things are going. I mean, my gosh, just the last couple of days, there's been great discussion in the financial media about changing the accredited investor rules. I think rough numbers, the population in the US is 10 to 15% accredited. And to the extent that loosens and access is greater, I think we're in really, really early days. I think it's critical to have great solution there, but it's tough to underwrite that entire process of all that's involved in it. There's a lot of solutions in the marketplace. There's a lot of variance, and it's really important to get that piece right. But I think it's a must.
You've gone down the path of really trying to create a customized solution. You mentioned you're creating this private fund. I'd love to hear a bit about that and why you think that path makes sense as you think about there's so many different ways to do this. You could invest in certain firms' funds. You could invest in fund of funds. You could invest in soon model portfolios. You could create your own fund. Why go down that path? And what about that made you really say, you know what, this is how we should think about doing private markets?
When we embarked on this effort in 2012, our approach had been to be very slow and meticulous around the approval on our platform of a call it a 10 plus group of approved private market exposures that are all different from one another, and just be really careful and kind of slow, frankly, in that process. And, in the end, our investment team and the lengthy time spent there felt really great about each and every approval that took place over the years because of all the diligence and effort and time that went into it. And in the end, what we ended up realizing is that the education curve is ambitious. If you think about communicating all the time and energy spent from the investment team, whether it's outsourced or in-house or a combination thereof, to advisor, to equip them to then get in the gauntlet, if you will, of a client conversation and be able to get through Q&A, it's a heck of a task.
What's the hardest part about that? Is it that advisors need to be educated on private markets? Is it that they have so many other things that they need to think about, and this is only one aspect of the day-to-day that they would have, the things they would talk about with a client and that a client cares about? Is it something else?
Responsibilities that they have in running their practice are significant. I think the complexities of the investments that we're talking about is a whole nother. To understand and have spent enough time to be able to not only talk about the particular strategy, but then to get through further Q&A is another facet. I think the other thing, really, if we look at the last 15 years, is we've been in a beta-driven public markets framework. And so if you don't have to create any kind of friction, so to speak, or extra work, then you're probably not going to. But my belief when I go forward is that we're in for something different than what we've been accustomed to in public markets.
What does that difference look like to you?
I think it's marked by volatility, not only in public markets on the equity side. I think it's marked by volatility in rates and inflation, which certainly changed valuation metrics in the whole capital markets landscape. I think Hamilton Lane, by the way, I think is a great study on the separation in performance. If you take your average PE and look at high return public equity regimes versus lower, the separation is significantly wider in lower public market equity expectation. And so for us, if you look at anybody's forward return expectations work, Vanguard or anyone else for that matter, they all sing from the similar tune, which is expect something significantly less than what we're accustomed to seeing. I think AI is a differentiator there. Could we see a robust productivity boom? Sure. But I would also say that the landscape that we were in the late 90s with 8,000 plus public companies and roughly half of that now, I would argue that some of the most exciting things from a innovation perspective are happening at the private company level. And we see that through kind of the boots on the ground work that we're doing.
So then you mentioned all of these challenges. The game on the field has changed. It's a different interest rate environment, more volatility, more geopolitical volatility. What does that mean in terms of where to invest going forward? And how do private markets now fit into that, maybe even in a different way than they did before?
Yeah, I think the part of the way that we were solving for that with the launch of our first 3C7 drawdown fund is to try to create a really bespoke list of 10 to 15 managers and strategies and give it enough diversification so that you've got some cash flow producing assets in there. You've got some longer duration assets like venture, and combining from a total return. I mean, again, to be clear, this is still 10-year plus money, right? I think, but being able to make that process easier for advisors and ultimately clients to be able to take advantage of a diverse set of what we really feel are niche alpha generating strategies all in one fund solution is really exciting. I think we've got, as I mentioned, 10 to 15 managers, and we've done evergreen funds historically. We've done drawdown funds historically, and the experience has been good. But to be able to take advantage of some of the dislocations in private markets that have happened in the post-COVID world where, public equities have made up a lot of that ground. And I would contend that there's perhaps a bullwhip effect type of opportunity in venture and segments of private equity and otherwise.
Are there areas of private markets that you think will do well in a higher inflation environment, higher interest rate environment? And how does that also pretend? I know you mentioned venture rates, risk on, rates lower tends to be good environments for venture. How do you think about all of those dimensions and dynamics?
It seems like the venture ecosystem has adapted to that over the last couple of years as the rate backdrop has become, more persistently higher. There's certainly been a reset in a lot of parts of that market. I don't expect necessarily, high persistent rates. I think there'll just be volatility around the rate and inflation backdrop. I think it will ebb and flow over the course of time, which creates dislocations and opportunities. In terms of particular segments, I think the secondaries market is a really interesting market to us. Real assets and infrastructure, again, more on the more conservative side of things, but cash flow oriented segments of private equity as well that are generating cash flow in that backdrop, I think makes sense as well.
Do you think clients understand a lot of the nuances of private markets? So are they comfortable with trading some liquidity for illiquidity and going longer duration, maybe generating higher returns as a result? In certain cases, obviously manager selection matters, as we both know, but and advisors too, are they comfortable with some of these dualities of private markets that may not be present in public markets, like illiquidity, risk, not being able to, maybe in some cases, not having cash flows?
Through the advisor lens, this is such a critical topic to be understood. I think we're still in these early days of this evolution and the education around it. If properly communicated in the context of one's longer financial plan, if any advisor is managing money for multiple decades and then some, if you look at this as the kind of the long duration growth segment of the portfolio, really the growth engine, and even framing it through the lens of look at what the Mag 7 has done in large cap tech. I mean, do you cross your fingers and hope that continues to work, or do you think a little bit differently in terms of sources and streams of return to complement a liquid portfolio, which is absolutely critical to your point?
It's an interesting question though, because the reality is, and I'm not even necessarily going to allude to retirement accounts and putting private markets in retirement accounts, which makes a ton of sense, right? That matches a certain time horizon with assets that may be longer duration. But for many wealth clients, shouldn't they, even in their public markets, be thinking over long time horizons? So even in public markets, you see all these charts and schools of thought of, hey, yes, maybe there are drawdowns, maybe there's volatility, but the reality is, like, you should be invested, stay invested.
You should be thinking that way anyway.
Why do you think that there's such a difference in the way that people think, and how much liquidity do people really need? Because the reality is like, you could take a private equity-like approach to investing into a long-term theme or trend, AI, even alternative asset managers, right? Like, if you believe that AUM is going to grow, the publicly traded alternatives managers may be great bets over a 3, 5, 10-year time horizon. So why do you think people have this bucketing?
Without question, I think you're spot on. I think it gets back to the behavioral bias, I think, right? And people have, generally speaking, the peace of mind of getting access immediately if needed. It's also it's probably not ironic as well, some of the studies that have been done about investor returns relative to benchmark. And I even saw a crypto study recently, I think it was by Lending Tree, in terms of how many crypto investors were actually profitable. It was kind of a shockingly low number. And again, those are, at the end of the day, those are behavioral.
And the reality is, if they just invested in Bitcoin early and held it and through all the volatility and didn't do anything else, they'd probably have done relatively well.
That's right.
Depending on when they invested, obviously, but.
Right. That's right. I think if properly sized from a position sizing and overall private market sizing in the portfolio, that framework around long-term investing and aligning with the growth portion of it is.
This relates to something so KKR put out a study and report on evergreens where they said, obviously assuming a number of factors, but if you get 10, 11% annualized, you're going to generate 3x multiple on invested capital in an evergreen structure. And that's the case for evergreens, is that you can have a bit of a lower IRR, but still generate a multiple that would be somewhat similar to a drawdown fund. That got me thinking, well, okay, so like people should think in 10-year increments. Why don't investors think in 10-year increments? Again, whether it's for public or private, because if you think in like the length of a drawdown fund is generally 10 years. What if everybody thought about investing in 10-year increments and you said, okay, how do I do 10, 11% annualized across my public private portfolio? Try to get that every year. Not that that's easy, but try to get that every year over a 10-year period. You do that for another 10 years. That's pretty meaningful compounding.
Very meaningful compounding. And you're right, as that relates to private markets, we can think of, and that's the whole, I think, beauty and point of diversification, not only within public markets, but incorporating private markets, is we're going to experience these long periods of potentially significant low or non-performance. We've seen it with the S&P, we've seen it with small caps, we've seen it with private market asset classes as well. And so that's how a proper framing should be done with, an advisor in a financial planning moment, is taking that long view.
What's the most challenging aspect of educating advisors and then clients on some of these aspects about private markets?
I think it's the consistency. When we communicate with our advisor base, again, a really sharp group, interested group, but it's the consistency of the messaging so that they can learn from our team and others and formulate their own story, if you will, but that takes repetition, right? So, we have monthly investment firm meetings, we have office hours, we have special education sessions and webinars to continue to teach. We've done state of the markets and venture with Allocate and others. And so I think it's the repetition and getting them comfortable to be able to tell the story in their own but related way.
On that point, what do you think, or what would you tell alternative asset managers and traditional asset managers who are trying to educate the market on private markets? What would you tell them to do to educate in an effective way?
I think the connection with the advisory firm is really one built around that. It's so much less about the product sale and so much more about the differentiating factor, the team, the process, the uniqueness. I think the education portion of that is the cornerstone. So a firm that does a great job on the education piece, I think, tends to have a lot of success. And we've experienced that. We've worked with Blackstone for a number of years, and they do just a phenomenal job on the education piece.
What's resonated so well about how effective education has been done? Is it that it leads to trust? I'm sure it does to some extent, but is there something in the way that they're educating?
The consistency and helping it make sense, right? I think if you compare public markets to private markets, they can be so much more complex. The vernacular that we're all familiar with is typically just very different than what the end client is used to. And so being able to incorporate storytelling and help it be more tangible and make sense, kind of, you can touch it and feel it type of experience.
So Blackstone obviously pioneered that, Blackstone University. Did. Joan was sitting in that seat a little while ago. Access to both education and even investment product is now table stakes. Mm-hmm. In your mind, what is the next frontier for education? What do you think that you, your colleagues, or your peers as firms need from an education perspective? Because now they can all get the private markets 101.
I think as we look forward, and really as it related to this effort for us and this fund that we've created, it's the sourcing and access, I think, is really critical. I think there's a desire to pair big firms and brands who have great proven track records of success with perhaps a little bit smaller, more niche opportunities that are a little bit more focused on alpha generating. One's not right, one's not wrong. Different risk profiles, but the opportunistic nature of some of those more bespoke opportunities. And so on the education front, helping kind of the advisor and wealth community on education around the big firms and strategies, the small niche strategies. And we've seen plenty of studies around the dispersion of performance within VC, especially, and private equity.
How do small managers go about navigating the wealth space, though? Because they don't have the resources of the larger firms like a Blackstone. They also may not know that you're interested in private markets. And obviously, there's technology solutions and platforms out there, but what can smaller managers do to be able to find you and then also educate and build trust? Because that is so important, as you were saying before too. There's
been some smaller managers that we've had great success with. I think, it's some of it's networking, some of it's conferences, inbound. We get a whole bunch of inbound, and really it's those firms that separate themselves on the intro and instead of just a product pitch, that differentiating factor, the uniqueness that can often lead to a tell me more moment, to learn about what they're doing and what makes them unique.
I think this is an interesting point to talk about because it feels like in the wealth space, we're at a point where customization and differentiation is important for the wealth manager in terms of access to private markets. I think you're a perfect example of that, where you've done larger managers. You're now building your own customized solution as someone very well versed in private markets. What do you think about that aspect of where we are in the wealth channel? Is it the type of thing where you feel like customization and differentiation is needed because that's how you end up adding a lot of value, and that can be where you really separate from the pack, and as a firm, you're on a growth path as well. So you need to do something different because that's how you really add value.
Yeah, I think the customization is an important differentiator. I think even beyond that, you need to be in the game. I think the proactive thoughtfulness around what's our strategy in private markets, how are we solving for it, how are we providing access to our advisor base, what does portfolio construction look like, position sizing, all of those things. I think for us, we've gone from this place of, and we have some terrific partnerships and firms that we have worked with for many years that we still continue to work with that fit in different segments of the portfolio, and this evergreen funds and drawdown funds and now as it relates to us and differentiating from our peers, it's that combining the benefits of the big, successful, recognizable brands that have been there and done that, but also finding these unique, smaller funds that have great stories and great track record in their own right. They're just not as recognizable and understood in the kind of the mainstream financial media as others, and really constructing a solution that scratches a lot of itches, right? I think, one way we could have solved this is to do a venture fund and do a PE fund, right? And private credit, et cetera. The way that we've underwritten this is one where it provides meaningful upside for the long-term investor from a growth perspective, but it also provides other exposures that are less volatile, that have kind of some downside stress testing, more cash flow oriented as well.
I love what you just said in terms of describing how you think about it, which is being in the game. And I think that is so important in private markets. And I think it's an important element of the evolution of this space is knowing the players, knowing who they are, knowing what their heritage is, what their history is, what they've done. I think that probably helps you make an allocation decision. And like you said, it takes time and effort and trust, and you need to be doing it. What advice would you give to those in the wealth space who need to get in the game? How would you tell them to go about being in the game, maybe in the way that you did?
I think the evolution of the evergreen fund structure has been tremendous. There's a great number of firms that have built some incredible investment solutions in that way. And I think it for folks that haven't allocated there already, that's where I would start. You can have many broad-based solutions, direct investment and credit and secondaries. And I mean, there are solutions that have a number of different exposures, so you don't need to build it your own. So that I've seen that take place over a period of years now. That Evergreen solution is, I think, the best place to start, and really start with what are we trying to accomplish. The education, as we've touched on, with the advisors and ultimately the end clients, but just to be thoughtful about what are we trying to solve for here, whether it's return or whether it's different exposures in certain segments of private markets.
How do you think about the nuances of evergreens, and how do you go about navigating that markets? Because there's different strategies. Some fit better in evergreens maybe than others. There's different structures. There's interval funds. There's tender offer funds. There's managers who've been in it for a longer period of time than others. How do you think about actually navigating the evergreen environment?
I think you want to start with what the objective is for the private markets. Is it cash flow? Is it cash flow oriented strategies that are a little bit more conservative and less volatile in nature, looking to complement the core public markets portfolio? Are you looking to solve for taking out of some of the equity risk budget? And, in that case, maybe it's a venture PE or both in some combination, because there are certainly great solutions in all of it. Or do you just say, I want just a private assets bolt-on that's kind of a catch-all that really tackles a number of those different segments within private markets, which are also available too. So I think there's a great deal of flexibility, but I think you really need to be thoughtful about what the objective is.
I think that's such an important point, because it leads to a really interesting question of then how to think about portfolio construction within private markets. How do you think about the interplay between evergreen structures and closed-end fund structures?
Historically, we have used the evergreen structure as more of a core strategy in a lot of, or core allocation in a lot of ways. And maybe we've used some more niche drawdown closed-end structures around that core strategy that might be a little bit more investment specific. In our earlier days, allocating to what I would call some of your earlier core private market exposures, such as credit and real estate, the evergreen structures worked and continue to work very clean and easy in that regard.
Do you think going forward, evergreens will continue to be the core way in which you allocate to private markets? Because there's also a operational component, particularly in the wealth channel, where you have new clients coming in. It's easy to get them invested in something rather than have to wait for the next vintage, and then you have to figure things out, and there might be a drag on returns if not. So do you think that will continue to be the core, and then closed-end funds and more niche strategies will be the satellite?
I think so. That's ultimately our ambition, is to evolve in this drawdown structure into a evergreen structure. That'll take a little bit of time, but that's the ultimate ambition, because we do view that as the core piece of the private markets. And then you can use some of these add-on or more niche strategies around.
What do you make of the entrance of model portfolios into the equation?
Such as
like what BlackRock and Partners Group are doing with a model portfolio. iCapital has some model portfolios of multi-manager, different strategies. Like, do you think that advisors will want plug-and-play solutions and just have it be there and easy? Or do you think that there's still a more artisanal approach?
I think it's a really beneficial evolution, because I think there's a place for both. I think for many advisors that want ease, they know they need to be playing in the space, but are looking for well thought out, but more easily accessible, more convenient type of ways to play in the space. I think there's absolutely a place. I think the upside is so significant that there's going to be a large sandbox with a lot of different strategies that are utilized over the years to come.
Well, you mentioned a lot of different strategies. I always like to end by asking people what their favorite or most interesting alternative investment is. I'm going to add a twist to it. So first, I'm going to ask you, going forward, in your mind, what is your favorite or most alternative interesting investment? Favorite or most interesting alternative investment?
I think the secondaries market continues to be so interesting just due to the lack of liquidity that's existed now for a number of years. But I think separate from that, I think the emerging manager space in venture capital is actually really exciting.
Why?
I think there are so many talented people, whether they were with big firms or whether they're former operators that have launched or are launching their own funds, and they're raising smaller scale funds. I think from a risk reward perspective, I think they're looking at the world in a much more disciplined way, perhaps that didn't exist prior in VC. Again, they've had to, right, as a function of the capital raising environment and liquidity and interest rates. I mean, there's a culmination of factors that have influenced that space. But I think from an upside perspective, that's a space that I'm really excited about. I had the pleasure of going through the LP Institute with Decile Group to kind of sharpen my skills from a qualitative perspective as an LP in that space. And yeah, just really, really enjoyed it.
Venture might be really interesting right now. There's so much innovation happening. AI is really changing a lot of different industries. So that, I think, and how do you access innovation? There's all sorts of ways to play the AI space. You could invest in data centers and the infrastructure side. You could obviously invest in the big chip makers, et cetera. Right. Or you could play it through venture, and all of those are interesting. I want to flip things on its coin.
Okay.
And ask, what is your most contrarian investment idea right now?
I think there's a significant amount of dislocation in the real estate market that's happened. I think it's ripe for opportunistic type of niche real estate strategies.
Well, that'll be fascinating to see play out in terms of where and how. One second layer question on that. Mm-hmm. In something like real estate, is that something where size and scale really matters? So you'd go with the large managers to express that thesis, or is that something where more niche, smaller managers are the right fit for that?
I think both can, without question, win. You know, some of the large managers are just going to be some of the only players, and they'll have leverage, I think, in the space and have access that others won't even see or know about. But also the niche opportunities, smaller deals, I think, can be had with some of the dislocations that have happened. Yeah,
I love that, because we get one perspective, venture and growth and the opportunity there, but then on the other side, income and yield, right, with really interesting dislocation in the market. So I think that's a great juxtaposition, and this has been a fantastic conversation.
It's been a blast. I appreciate it.
Thanks for coming on. It's such an interesting perspective on wealth management, on private markets, how to think about it. So
thank you.
Awesome.
Appreciate it, Michael.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot, and have a great day.
We're going